This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Trevor Garvin from Net Group Investments Multi-Manager. Today's voice note is entitled, Ongoing Conflict in Iran Continues to Cause Market Volatility. Over the past week, markets have oscillated between risk-on and risk-off as investors assess whether conflict will de-escalate or turn into a sustained regional war. Importantly, the Strait of Hormuz remains a focal point, given that roughly 20% of global oil and gas flows pass through this channel. Both Iran and the US had put ceasefire proposals on the table in the last 24 hours, both of which had been turned down by each of the respective parties. The VIX Volatility Index rose sharply during late March, but has eased slightly as markets price some probability of containment. Equity markets in the US delivered their strongest weekly performance in several months, with the S&P 500 recovering roughly 3.4% last week after a 5-week losing streak. European equity markets have been more constrained, pressured by higher energy costs and weaker growth expectations. Indices such as the German DAX and the French CAC 40 remain lower month to date, despite a short-term rebound. In South Africa, the JSE All Share Index has shown relative resilience as well. Over the past week, the market gained around 4%, driven primarily by a strong rebound in basic materials, which surged by 10.3% as the higher gold and platinum prices lifted large mining counters and reignited interest in resource stocks. Gold prices are trading at around $4,650 per ounce, and platinum group metals have also benefited. Stocks such as AngloGold Ashanti, Gold Fields, Sibanye-Stillwater and Impala Platinum have been amongst the strongest contributors. Oil prices remain the primary macro transmission channel. Brent crude is currently trading at around $109 per barrel. That represents an increase of more than 10% over the past month, despite significant daily volatility. Elevated oil prices raise global inflation risks and complicate the outlook for monetary policy easing. Bond markets have responded accordingly. Global yields remain elevated as markets reassess the timing of interest rate cuts from the US Federal Reserve and the European Central Bank. Both the US Fed and the South African Reserve Bank have kept rates unchanged and on pause at their last meetings. The US 10-year bonds are trading on yields around 4.34% as of last week. In South Africa, the 10-year government bond yields are trading at around 9.1%. Yields have increased from 7.9% at the end of March, resulting in around 7% of capital losses for domestic bonds. The rand has been volatile but relatively resilient compared to earlier geopolitical shocks. As at the 6th of April, the currency is trading at around 16 Rand 86 to the dollar, weaker month to date, but supported by higher commodity prices and improved terms of trade. The South African Revenue Services achieved 2.01 trillion rand in gross tax collections in the fiscal year 2025-2026, breaching the 2 trillion rand mark for the first time in its 30-year history. The financial year 2025-26 figure exceeded the original budget estimate by 25 billion rand. The government has temporarily reduced the general fuel levy by 3 rand per litre. The measure, aimed at cushioning the economy against a severe fuel price shock, resulting from a nearly 50% surge in global oil prices and rand depreciation due to the Middle East war, will be just for the month of April and will be reviewed for next month's fuel price adjustments. Without intervention, petrol prices were set to rise by 5 to 6 rand a litre from 20 rand to 25 rand, and diesel by 9 rand a litre from 18 rand to 27 rand. The Treasury indicated the revenue cost will be around 6 billion rand in lost revenue, and the amount will be recouped within the existing 2026 budget framework. For investors, periods like this are uncomfortable, but not unprecedented. History shows that geopolitical shocks tend to create short-term noise rather than long-term structural damage to diversified portfolios. Assets, regions and currencies, and a focus on quality exposures remain critical. With thanks, till next time, Trevor.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.